Hello, everyone. This is Mike, your legacy wealth coach, here to talk about the misleading nature of average rate of return. It's not always what you think. So, an average rate of return is simply the number that is used to calculate how your investment has done over time. So, let's see what that means. All right. First, let's look at investor one, average Andy. He starts investing with $1,000. In year one, he does great and gains 50% profit. In year two, he doesn't do so well and actually loses 50% in the market or whatever he's invested in. But by year three, he's come back a bit and he earns 30%. Not bad. This is what it feels like for him, right? Roller coaster, but that's real life sometimes. Now, using the average rate of return, remember he went up 50, down 50, and then up 30. He should be using this calculation where with average starts with the positive 50 plus his negative 50 plus his 30% gain in year three, nets 30%. However, it's over 3 years, so you must always divide by that 3. And his result is the plus 10% gain for his average rate of return. Simple enough. Let's see how that breaks down. Remember, this was over 3 years, so 10% per year for 3 years would look like this. In year one, $1,000 times 10% is a profit of $100. In year two, 10% of now 100 plus 1,000 or $1,100 results in a profit of $110. And you guessed it, in year three, 10% of that new total of $1,210 is a profit of $121. So we've got year one, 100, year two, 110, year three, 121. That's a total profit over 3 years of, added up, $331, right? Well, this is the great average return, I would say. After investing in 3 years, average Andy's ending balance should be at $1,331. Using average rate of return, this results in a 33.1% gain over 3 years. Something to toast, I would say. That's a great average return. But really, how did Andy really do? Let's look over those 3 years, shall we? And again, year one, average Andy gained 50%. Now off of $1,000, that's a $500 gain. So that's $1,500. Follow? Year two, he lost 50%. But this time it's off of the 1,500, remember, not 1,000. So half of 1,500 is 750, which is also what he's left with in year two. Starting year three, he does great, gets 30% positive gain. But again, this is off of the 750, which you do the math, 750 plus 30% of that is 975. Okay, so where are we at really here? Now, is $975 a profit of 33% from the $1,000 initial investment? I'm no math genius, but those numbers don't look quite the same. Your real rate of return using real numbers is actually a negative $25, or in this case, negative 2.5%, and not the 33.1% that we thought we had. What seems like a profit actually ended up a loss. Yes, there it is. 975 does not equal 1331 in any universe. So what's the moral of this quick story? Well, average rate of return is a quick calculation, easy to do, but it is limited. Now, it may overstate, like it did greatly in this case, or sometimes even understate the real returns. And then because of that, it can be dangerous to rely upon. And so my button stopped. Here we go. The most important is to focus on your actual account values. And always, always do your own research. Nobody's going to care about your money more than you will, right? That's how I got started in all this. So thanks again for listening. I'm Mike, and that is Pay on the Right. We are your legacy wealth coach. If you want to contact us, you can email us at legacywealthcoach@gmail.com or follow us on Facebook and Instagram. Thanks again for watching, and until next time, take care.